All right, just while I'm loading everything up, I should mention I've gotten through around 3/4 of your assessments. I should have the remainder done by Friday, so your results should be released on Friday, or at the latest around Saturday. So they should make for some good reading for you all. Morning, Ron. Does it say that for? It's very annoying. It's not correct. No, it's 50. It shouldn't say 60. I don't. Yeah, no. It should be 50. I've changed this in here. The old version was 60, but it's not 60 anymore. Yeah, so it's the same one that's in the 2 sample papers. All right, so let's make a start. Just wait for the projectors to start working. So my sincerest apologies. These notes make reference to a 60-mark paper. The paper was historically worth 60 marks. Okay, it's now worth 50. Okay? So something to be mindful of, largely because your assignment is weighted a little bit more heavily than it used to be. Your assignment used to only be worth 30 marks. As of this trimester on with it, it's worth 40 marks. Okay? So I'm just going to go through the overall paper again. I know that's what you care about at this stage, and now I can be a little bit more precise in the guidance I offer around your preparation. All right, so a few things to be mindful of. The question paper is predominantly calculative, which I think works in everyone's favour. I think it's challenging to do poorly in those sections if you've prepared adequately. Just in terms of your overall preparation before we kick off, I would actively encourage you all to try to review the lecture notes first. Okay, there'll be nothing presented on your paper that's beyond those notes. Okay? For those of you that want to delve a little bit more deeply, most certainly there are the extraneous materials, the additional materials that I provided, but your lecture notes should be your starting point in terms of your preparation. Beyond that, I think it's also important that you have a really sound understanding of just how to write for certain styles of question. I do find that people fall into 2 camps when it comes to writing responses to the conceptual style questions. Try to look at how we've framed things in the notes. You'll find that the lecture notes generally don't suffer from too much verbosity. Generally, they're fairly concise, and ideally you write with some concision. Okay? That is not to say you take it to an extreme. If you are falling short in terms of time, by all means, of course, you can use dot points or abbreviated speech, but I would encourage you, wherever possible, to use full-form responses. A couple of key things, though. It's very, very common, particularly from those that have operated within other models of education. When you come here and you write your responses to any particular examination paper, there is often this ingrained habit of writing everything that you know about a particular topic, okay? There is no model of extra credit in Australia. All you're doing is wasting precious exam time. So I'd really actively discourage that, okay? Don't write a history on the topic, just answer the question, okay? I've had candidates write 4 pages of very, very neatly presented print without actually answering a question. And it happens, quite a bit. Have you ever watched a game show and people are unsure about the answer? They tell you about every other proximate aspect of the question that they're familiar with, so as to suggest that they know something. It doesn't really work. What I would say, though, is make sure you put something down that is proximate to the answer. If you know nothing, you might surprise yourself. But if you do know the answer, get to the point quickly. All right, 2 hours can go very, very quickly under exam conditions. All right, it can really, really move on you. So that's the key thing to be mindful of. There are no multiple choice questions. All right, so please bear that in mind too. Often with a multiple choice exam, and yes, I will concede that in earlier iterations of this paper there were some multiple choice versions for those of you that went to the library and perused them. In those sorts of assessments, it's very easy to churn through questions fairly quickly. It's slightly harder with a set of short form questions. Okay? We don't use multiple choice assessment at the university anymore for this style of exam, and if people are doing that, they're breaking the rules. All right? We're not supposed to be. So please bear that in mind as well. With a discussion-based response, write with concision, get to the point. You do not get rewarded for all of the preamble or extraneous material. So the paper is not that different to prior papers other than the weighting of marks. All right, so you can use all of those past papers as being indicative. All right, so you've had a couple that you've been able to work through. We'll work through some additional material again today, and that should hold you in good stead come that final paper. When it comes to responding to the numerical portion of the exam, I'm sorry, I have no idea where that sound's coming from. For those of you that are wondering why people are giggling, there's some sort of weird squeaking sound coming out of the corner of the room, but there's no one there. So we're going to move on. So for those of you that are new to responding to numerical exams, and I do appreciate there are some of you from a pure law background, pure humanities background, when you respond to numerical questions, please make sure that you make very, very clear the steps in the process. It can be very challenging and problematic if you don't. Okay? It's highly likely that I'll be marking the majority of the papers, okay, at the very least half of the papers, so it's not too much of an issue. But if, for argument's sake, a third party was to mark them, it makes it very, very hard if you just present an answer. Okay? If you present an answer to me, I can generally look at where your variation comes from. Okay, but I'm not required to, nor is any other examiner. So technically, you can be assigned a 0 for an incorrect answer where no workings are shown. So ideally, you show your workings in full. If you're using a mathematical approach that involves first principles, maybe just include, for example, the inputs and the sequence of steps. If, for argument's sake, you're using a formula, please include all of the input values and your answer. If you're using a financial calculator, this is particularly important. All right? I know that many of you are going to use financial calculators, particularly for bond questions, bill questions, and also share valuation. All right? It's really, really important that you put those steps down. Okay, we've talked about the topics ad nauseum, so I'm not going to dwell too much. What I'm going to do is just take a moment and talk specifically about the theoretical segment of the overall paper, all right? I think in terms of the calculative part, we've done a fair bit of preparation. So today I'm going to be talking about a few of the theory questions as well, okay? So I can't tell you what's going to be on your paper even if I wanted to, and I wouldn't even if I could, but I can't anyway because there are 3 versions of the paper, all right? So what I'm going to do, unfortunately, is tell you what's within the scope of all of those papers. That means that you do need to prepare yourselves for each iteration, each version, okay? So across all of the assessments, there is going to be a focus on certain theoretical constructs. This semester, our focuses are on traditional monetary policy, asset securitization, recourse and non-recourse lending practices, Fisher's law and Fisher's equation, Fisher's law and Fisher's equation, Fisher's law, Fisher, Irving Fisher. We've talked about that one before. Fisher's law, Fisher's equation, and obviously the associated inflation discussion. It's unlikely that you'll get the version 3 paper unless you have a clash, but if you do, I'll certainly, those of you that are obviously sitting at a clash time or later, for example, those of you that aren't sitting at this iteration, you're allowed to contact me over the intervening period between this exam cycle and the exam cycle that you sit to contact me for further clarification about any emphasis relating to your paper. Okay? But they're the primary theoretical focuses. There might be some associative questions, some general theory questions that relate to interpreting existing calculations. So you might do a calculation, you might be required to provide some comment, offer some insight, engage in some associated analysis as well. That is also a form of I guess, theory-based discussion. But they're the clear and independent theory questions. Gosh, really? I don't know if I can remember them myself now. I'm just kidding, of course. So in terms of the most important theoretical focuses, independent areas of focus for the subsequent examination, our real emphasis in terms of the theory this trimester is going to be on asset securitization. Okay, asset securitization, and perhaps the association of securitization with issues of crisis. Okay, but in particular, securitization in isolation. But there is obviously going to be an associative discussion that you need to be familiar with. Okay, so asset securitization, monetary policy, but traditional monetary policy. You might recall that other versions of the paper have focused on modern practices such as quantitative easing and credit easing. This semester, our focus is on the economics of traditional monetary policy. Economics of traditional monetary policy. All right. In addition to that, we're also going to be focusing on recourse and non-recourse lending practices. Okay? And you need to be familiar with the association between recourse and non-recourse lending practices and the broader global financial crisis. All right? I'm actually going to supply you with a reading, but you can certainly study that independently if you want to. Okay? I do apologize for that sound. I can see that it's really annoying several of you, based on your facial responses to the sound. What we have to do is sort of block out things sometimes. I can't do anything about that. I mean, I can speak to the gentleman in the ceiling and ask that he is a little bit less squeaky, but I don't think that's going to work. I do apologize, guys. All right, and finally, beyond those areas of focus, we're going to be looking at Fisher's law and Fisher's equation, okay, and its association with inflation. That's a very, very simple construct, okay? That's one of the slightly more simple questions of the bunch. Okay, in terms of the, I should also mention this, I think it's as a matter of fairness, in terms of associative theory questions, when we engage in any form of implicit rate calculation, okay, and a version of the paper does include that, when we do encounter any sort of implicit rate calculation, when we're calculating an interval rate or extrapolating a long rate from a set of shorter intervals, you need to be able to offer interpretation in light of the theories of interest rates, and in particular, pure expectations theory, sometimes abbreviated as expectations theory. Okay? So how does expectations theory and liquidity premium theory interact with those calculations? How are those calculations, for argument's sake, based in expectations theory? To understand both, to be able to do the calculation, I'll concede, you don't really need to be able to understand the theory. But to understand the theory, you need to be able to understand the calculation. All right? So I just think it makes sense to revise both concurrently. When you're doing all of that calculative work, review the associated theory. Okay? It's not hugely complicated. We are going to go through it today. Okay? So pay particular attention as we go through those questions today as well. All right. I am going to put a brief note online about this as well at the end of the session. Okay? So you have it for your record. But as I said, there are multiple iterations of this paper, so don't just prepare for half of it and think that you're going to avoid the other half for argument's sake. It's not how it works. So, because we're in this environment today, I thought it was probably best to just include the questions in Q&A style in the way that I've perhaps done in the past. Last trimester we were able to do a workshop, and I do feel that was fairly productive, and I will take your feedback on that for going forward sessions. But given that that isn't available to us today, I think this will be more than sufficient. And for those of you that want any help beyond this session, you obviously have my details. So we're going to start by talking about theory. Today is a little bit more theoretical than last time. We're going to digress when we cover off on important issues as well. All right. So historically, candidates do quite well when it comes to the calculative segments of papers, but they do, I'll be frank, less well when it comes to the theory sections of most papers, all right? And I think that is because, in part, obviously mathematics flows from logic, okay? It's very, very easy once you're familiar with it to ensure that you get a response correct. Theory takes a little bit more time, so it's really important that we embed core concepts well. So that's what we're going to do today. So you'll recall that I mentioned that one of the core focuses of our paper is securitization. You need to be able to explain securitization. You need to be able to unpack that concept in light of the associated financial crisis. While the issues are going to be considered in isolation, there isn't an association between the global financial crisis that we observed and asset securitization. So what we're going to do is consider securitization in isolation and then consider its associative relationship with the global financial crisis now. Okay, so very, very simple question. What is securitization and what role does it play in banking? Okay, even though it was at the heart of one of the major modern crises, it is not something that we're going to see go away. If anything, we're going to see even more of this style of activity in the future. We're just going to see it happen in a slightly different way, in a slightly more mooted way, and undeniably with greater checks and balances in place. All right? So what is asset securitization? Asset securitization is the process of pooling what would be considered largely illiquid assets that are carried by a bank or financial services institution into some sort of vehicle or entity form such that units or ownership stakes can be issued against the newly constructed vehicle. It's a very popular mechanism through which a bank or financial services organization can reassign and reprice risk. Why do banks and financial services institutions engage in this type of behavior? They engage in this type of behavior because, for all intents and purposes, it's a highly profitable endeavor, but it also allows them to transfer risk from their balance sheet. Okay? It allows them to assign risk to third parties, and that is obviously quite a compelling outcome. Okay? So it allows them to reorganize their balance sheet. Asset securitization has been around for a very, very long time. And we at Deakin, one of the few global institutions that were actively voicing concern about the rapid expansion of securitization securities, securitization-based securities, I should say, over the course of the last 20 years. And one of the key reasons for that is that it's very hard to look beyond the overall structure of the vehicle and understand what underlies the vehicle beyond looking at the information and available data made available by ratings agencies and obviously the securitizer themselves. Asset securitization is so popular that within some jurisdictions there is a separate entity classification for securitization. In North America, there is an entity form known as securitizer. You can be a bank, you can be a thrift institution, you can be a fund, or you can be a securitizer. That's how popular the activity is. Here, obviously, we're not as enamored with asset securitization, but it is an increasingly popular activity. More and more individuals are now looking to fixed income returns. Has anyone noticed the increased amount of advertising in relation to fixed income annuities in recent years? Anyone noticed that? I'm digressing, aren't I? I'm teaching rather than revising right now. My apologies. But we'll digress just for a moment because it is interesting. Who's been following that? Yeah? Who have you noticed advertising a lot? Yeah, and would you say Challenger? Yeah, so the reality is legislation has changed in recent years in this jurisdiction and in others to actively encourage people to engage in investment models and investment structures, engage with investment models and investment structures that provide more consistent returns and potentially lower evidenced risk levels. And for that reason, annuities have become incredibly popular again. And a huge number of funds and financial planners are encouraging people to invest in annuities again. It's a very, very old world thing, even though we discuss them so much in finance. The concept of investing in an annuity is not one that has been increasingly, well, I should say, it is increasingly popularized now, but it hasn't been popularized in recent decades because we really moved away from that mindset to a strong risk-driven mindset, taking on appropriate levels of risk while shying away from fixed return outcomes. But securitized assets provide the potential to garner consistent fixed returns. And so increasingly, they are becoming popular investment options even in Australia. All right, so that's securitization in a nutshell. The process of pooling, generally speaking, homogeneous, which means similar, illiquid, which means difficult to realize quickly at their value, homogeneous, illiquid assets into a vehicle and issuing instruments against them as a mechanism to transfer and reprice risk. By engaging in this process, banks are able to bring liquidity back to their balance sheet and engage in new lending efforts. So they garner a return from the original activity and they're able to engage in lending activities again. Okay? How is securitization associated with the global financial crisis? If, for argument's sake, you were required to provide some sort of statement as to the role of securitization in relation to the GFC, and I will concede the GFC was some time ago, but it's important that we don't forget. Financial services professionals have the shortest memory of any set of professionals in any industry. It's terrible. I'm part of that community. It's true. Okay? One of my favorite academics in the world is a gentleman by the name of Edward Maberly. Okay? He's one of the top 15 economists globally, a globally ranked individual who is a brilliant, brilliant econometrician, but an equally brilliant historian. And I think every economist should have that mindset. Every financial services professional should have that mindset. Have a very, very long memory. All right? So let's now, even though it was all of a decade ago, try to think about the role of asset securitization in the crisis itself. It might be very obvious to some of you, I'll concede, because you've had the benefit of probably some engagement with these issues in a professional context, professional setting. I'm guessing not everyone has thought about it, though. What is the association? Think back to Rahul's seminar, and I'll provide his lecture notes, actually. He put some good notes together on this, so you can review those too. It's one of his research fascinations. I think it's an interesting one. Any thoughts? All right, well, the key association between the global financial crisis and asset securitization relates to the manner with which asset securitization facilitated what we now describe as the financial contagion or the transference of risk between parties. All right? Financial contagion is the process of risk dispersing beyond its original locale, I meant to say local and I said local, locale or zone of influence. So in the context of the global financial crisis, it was a local crisis. It was a credit crisis described as the subprime crisis initially, all right? And it was driven by a decline in asset values. Housing prices declined and the associated securitized assets also declined in value and their yields also declined. How did it become a global financial crisis? Well, the contagion transfer would not have been possible if not for asset securitization. All of the original parties that carried the risk pooled assets into those special purpose entities and those trust vehicles and issued instruments against them, and various parties around the world were able to invest. If, for argument's sake, asset values declined, but the assets were still carried by their original holders, they weren't repriced and sold, issued as securitized assets around the world, we wouldn't have seen any contagion transfer, we wouldn't have seen any transference of risk. All right? So asset securitization was the mechanism through which a local crisis became a global crisis. Okay? Monash Council lost $4.5 million. Okay? Local council. I mean, you wouldn't think of local councils investing in subprime assets, but they were. Babcock and Brown lost $240 million in 2 hours. Okay? Macquarie Bank lost $550 million in 2 hours. Okay? Obviously geographically quite far from where the issue originally arose, but by virtue of asset securitization, there was a transference of risk. All right, so this is an important issue when it comes to theory. Formulate your own narrative around this. It doesn't have to be my own, but you need to be able to explain the process of securitization and its association with modern crisis events. Most certainly. So the assets carried by those major Australian investment banks, the yield performance was such that the asset value declined rapidly, which meant that their written down value or balance sheet value was going to decline substantially. The market caught wind of this and they saw a substantial decline in their share price as a consequence, in addition to losing actual balance sheet value. All right, so I really want to harp on this one again. Okay, this is the kind of question that, for argument's sake, could be associated with a calculation, an associated calculation. But again, I've already talked to emphasis. Okay? What is meant by the term off-balance sheet business as it relates to banks? All right, so this is another theoretical concept. Off-balance sheet business as it relates to banks. So off-balance sheet business is all business that gives rise to a contingent claim or a contingent liability. All right? It's not a fixed claim or fixed liability. In fact, there is an inherent uncertainty as to the outcome. In the context of modern banking, off-balance sheet business is now very significant, depending on the bank that you are looking at, whether it is a traditional bank or an investment bank. It can represent between 5 and 14 times the value. Okay, at most recent estimate, 5 and 14 times the value of on-balance sheet activity. So what are the categories of off-balance sheet business? Okay, these are the ones that you need to remember. Please, in particular, try to remember the first two. Everyone remembers the second two. All right? So the first two in particular, direct credit substitutes. A direct credit substitute is the provision of a synthetic credit substitute in place of actual funding. Consider, for argument's sake, an example involving an individual wanting to pay a counterpart abroad. I'm based in Melbourne, my counterpart is based in Shanghai. They're uncertain as to my capacity to pay. How can I provide them with some confidence? Well, I can provide them with a standby letter of credit provided by HSBC Bank that will provide them with a degree of confidence as to the likelihood of payment. That letter guarantees payment in the event that I don't. All right, the bank is not actually lending me money. The bank could lend me money, but it's not. So it's retaining that capacity, and it's providing me with a form of support that is one might argue was historically non-traditional, is not considered to be non-traditional now. They're providing me with an alternative to actual credit, hence the description, direct credit substitute. All right, so best example, standby letter of credit. Next category, the second most forgotten, is the trade performance related contract category. All right, if for argument's sake I want to guarantee a non-financial outcome, how can I incentivize a non-financial outcome? Well, for argument's sake, one mechanism or method could be the use of a performance bond. The performance bond will actively incentivize my counterpart to make good in relation to their non-financial commitment. And in the event that they don't make good in relation to their non-financial commitment, there'll be an economic benefit that flows to me. Okay, so that's the performance bond example. Okay, the last two are relatively straightforward to remember. Financial commitments provided by banks, such as underwriting agreements or credit cards, essentially convey a degree of commitment to a transaction, but no guarantee that the transaction will actually occur. Okay? In the event of the non-purchase of shares, the bank will pay for the remainder, acquire the remainder. In the event of a financial shortfall and the use of your credit card, the bank will extend you credit, but only in the event that you actually draw upon it. All right, final category, market-related and other contracts. Market-related and other contracts. So this is the all-encompassing category. Between 92 and 94% of all off-balance sheet business falls into this category. So we're talking about market-moderated contracts, those relating to commodities, those relating to derivatives, such as options, forwards, futures, and swaps, and macro-moderated contracts, such as those moderated by interest rate positions or third-party reference rates, LIBOR, SIBOR, BABEX. All of these fall under this category. Okay? We can record some value on our balance sheet. We will, in fact, record an on-balance sheet equivalent, but we're not going to record the contract's value in full, okay? Because there is an inherent uncertainty about the outcome. All right? So these are off-balance sheet items, off-balance sheet business. Why did I include that? That's fine. All right. So we're going to very, very briefly do a Basel capital allocation calculation. As I've mentioned, though, this was not an area of emphasis this trimester. Consider the following example. XYZ Bank provides a loan of $1 million to a company that has an A- rating, equating to an external ratings grade of 2, risk weighting 50%. The standardized capital requirement calculation is book value multiplied by risk weight multiplied by minimum capital requirement. What is the capital that must be reserved against this risk-weighted asset? How much capital must we hold if we are to make this loan? So we make the loan. How much capital do we need to hold against this loan? So book value is $1 million. The risk weight, given the external ratings grade, is 0.5 or 50%, and the minimum capital requirement is 8%. So it's simply 1 million multiplied by 0.5 multiplied by 0.08. All right, Basel calculations are nice and straightforward. All right. I think I included these because they were on your sample paper. That's right. All right. Risk-weighted assets. Consider the following. We have sovereign debt of $50 million with an A+ rating, corporate loan of $10 million with an A- rating, a retail mortgage of $100 million that is unrated, and a retail other category that is also unrated. Calculate the value of risk-weighted assets. Okay. The only way that you could do this is if you had the associated table values. Okay? So sovereign debt that is A plus has a risk weight of 0.2. A corporate loan that is A minus has a risk weight of 0.5. A retail mortgage that is unrated is 0.35, and retail other is 0.75. There are only 7 tiers. I used to have to actually remember this. You don't have to this time, so it's fine. All right, key takeaways from here. Generally, when this was examined, we look at the distinction between retail mortgage and retail other. Why is such a significant distinction drawn between retail mortgage and retail other when it comes to loan agreements? Why do we hold so much more capital against retail lending that is not mortgage-based? Nice simple answer here. That's exactly right. The lack of collateral, the lack of security, causes us to want to carry substantially more capital. Okay? So retail mortgages involve carrying limited capital relative to retail other. This is the reason that borrowing from a bank, when you don't present collateral or don't do so through a traditional chattel mortgage arrangement, is so much more expensive, because they're having to carry more than 2 times the capital. For those of you that want the table or want to review this in your own time, there are 3 chapters in the book that I provided on this. Okay, for those of you that are interested in banking, very, very important. For those of you that are not, you can forget about this as I move on to the next slide. All right. Okay, this question is an important one. Cannot emphasize the importance of being adequately prepared for theory. I want you guys to be the ones that actually take heed of this guidance and make sure you do well. All right, so describe expectations theory as it relates to interest rates. All right, it seems like a very simple question. It's a short question. It feels simple, but it's really not. All right, there are a lot of elements to the theory. Okay, so think back to this course. How many theories of interest rates have you learnt? Very close. How many did you say? Yeah. And there was one more. Remember? So we covered off on loadable funds theory, pure expectations theory, market segmentation theory, and liquidity premium theory. All right, so 4 theories. All right? It would make sense to review them. This is the core theory, because it serves as the basis for most of the financial maths that you do within both macroeconomics and also in financial mathematics. All right, very, very important theory. Often when you're doing calculations, you're doing a set of long-form calculations and you aren't even aware that they're underpinned by this. This is the basis for all of that. So even though it is theory, it's still valuable. So describe expectations theory, sometimes referred to as pure expectations theory, as it relates to interest rates. All right. Well, the great thing about finance and all the questions that you get is that the key assertion is in the question. All right? So the word expectations is in the question. So that should allude to your response. That should trigger something. There should be a connotation. Okay, some sort of internal reference that's made every time you see that word. So I want you to think of, for argument's sake, when you see the word expectations, likely outcomes. Consumers with generally homogeneous understanding or similar understanding. Okay? So expectations theory is about expectations. For all intents and purposes, the following would be sufficient in terms of response. Expectations theory asserts that current short-term interest rates and your expectations in relation to future short-term interest rates govern the shape and slope of the yield curve. Expectations theory is underpinned by a set of limiting assumptions. These assumptions are essential for the foundational theory to work. What are those limiting assumptions? Okay, this is the hard part to remember. Investors need to have homogeneous expectations, hence the name expectations theory. Okay, if they don't have homogeneous expectations, it doesn't mean that there is we lack the consistent expectation to predict the future. So we need a cohort of individuals that have relatively homogeneous expectations. Okay? The next limiting assumption is that there are no transaction costs or market impediments. Why is that a really important assumption? Yeah, we need viable competition structures, and we need there to be no switching costs. If I want to switch from a 3-year asset to 3 successive 1-year investments, I need to be able to do so at no cost. Okay? And there's one other very, very important assumption. It has something to do with market segmentation theory. It's what is inconsistent with market segmentation theory. Think back to that one. Market segmentation theory is a pure supply and demand driven explanation or explication of how markets function. There are separate segments within the market, hence the name. Pure expectations theory invalidates market expectation theory because it asserts that investments are all perfect substitutes. Investment maturity does not affect its substitutability. All right? We adjust these assumptions in the future when we deal with real-world challenges. All right? So we can adjust the transaction cost assumption, and we can certainly adjust the assumption in relation to substitutability as well. All right? But this is the starting point. You don't need to worry about the advanced level iterations. The basic theory, the core theory, is what you need to be familiar with. All right? They won a Nobel Prize. All right? It's a big deal. Okay, so how does pure expectations theory differ from market segmentation theory or segmented markets theory? The key point of difference is that pure expectations theory asserts pure substitutability regardless of investment maturity or duration. Market segmentation theory contends that investments are not perfect substitutes. All right? So it really helps when explaining any one of the theories to compare it with the others. It's the easiest way. The easiest way to explain one theory is to compare it to the others. You don't have to do that, but I would offer it is challenging under exam conditions to remember all of those assumptions. Okay? Sometimes it helps to reference the other theories. Okay. Okay. We've covered those other questions already, so I'm just going to skip over them. I want to draw our attention now to inflation and interest rates. Okay, and the work of Irving Fisher. Fisher's law, Fisher's equation. Okay, Fisher's equation, Fisher's law asserts that what? I'll give you guys an opportunity. I know some of you guys know this because you did macro as undergrads. Fisher's law, Fisher's equation asserts what? Okay, we'll read from the question and we'll set Fisher's law aside for a second. If financial market participants considered that anticipated inflation would rise significantly in the future, what effect would you expect this forecast to have on the slope of the normal yield curve and why? And sometimes you're required to draw the yield curve, okay, and explain how Fisher's effect impacts the yield curve. I know everyone hates theory. I know. What are you going to do? It's life, hey? I had to watch Collingwood win on the weekend, you know. We've all had to deal with things. I actually like Collingwood, but my mother-in-law is a Collingwood fan, so I feel like it'll make her far too happy if they win. And also, she's one of those fans that knows nothing about football, but is forever trying to talk to me about the fact that Collingwood are amazing. Anyway, you need to know this theory. Fisher's law, Fisher's equation, 3 components. 3 components you need to remember. Oh, you remember it? Good. What is it?
That's about inflation rate and real inflation rate.
Yes?
Nominal rate is like a combination of inflation rate and real inflation.
Very good. That's exactly right. I wasn't sure if you were going to get there, but you got that. That was very good. So how would you write it out? I don't give you guys this formula. This is one formula that you don't get. All right?
1 plus
N.
and nominal rate.
Yep.
1 plus inflation rate plus 1 plus real inflation.
Very good. All right. So very, very simple foundational economic concept. All right. Inflation impacts upon interest rates because inflation is a component of interest. Okay. The nominal rate that you observe in the market, the rate that attaches to a standard passbook account or a term deposit, should have both a real component and an inflationary component. The real component is compensating you for lost consumption. The inflationary component is compensating you for a general adjustment in the price of goods and services. If there is insufficient compensation, so if you're not compensated, at the very least, by the rate of inflation, you're losing consumptive power through time. Fisher's law, Fisher's equation, Irving Fisher asserts that the nominal rate, or 1 plus n, equals 1 plus r multiplied by 1 plus I. Okay? So the rate of inflation, the I component, if that increases, that's going to have an effect on the real rate directly, and by virtue of being a constituent component of the nominal rate, will also affect the nominal rate. So what you need to be able to do is you need to be able to explain that at a particular point in time, when inflation is anticipated, there will be an inflection in the yield curve. And we observe this all the time when we observe anticipated inflation, and ex post when we look at how unanticipated inflation has affected yield structures. We observe an inflection. Okay? Yields go up. All right, so that's Fisher's law, Fisher's equation. You don't have to use Fisher's law or Fisher's equation to explain this answer. You'll note that the answer is just talking about it in general terms, but I just think it's a really easy way to answer the question. All right, you just draw upon that theory. It becomes a very straightforward exercise. All right, more theory. Okay. So this is a foundational course in finance, which means that you'll encounter some foundational questions as well, all right, that relate to some of the calculations that you do. For example, if you're interpreting a set of beta values, or if you're commenting on what beta is as a coefficient measure, you might be asked a related question relating to systematic versus unsystematic risk. The good thing about being asked those associated questions, the related questions, is they actually help you with the earlier question. When you're answering questions, think about that. All right, if you're drawing blank about something, look at the associated components to the question. Is it helping you answer the initial component? All right? So this is a question that used to appear under a section relating to the interpretation of beta values. Okay, so students would have to calculate a portfolio beta, interpret individual betas, interpret the portfolio beta, and then they would respond to the following question. Define risk and distinguish between systematic and unsystematic risk. What factors are responsible for the two types of risk? So when I see those questions together, ideally the beta value orientates you to systematic risk and systematic risk measures and helps you understand that aspect, and then you need to be able to explain the broader two. So let's go through this again. Simple question, but under exam conditions, sometimes these things can be challenging. So what is risk? What is systematic risk? What is unsystematic risk? What factors are responsible for both types of risk? All right, so risk in the broader sense is any deviation from our expectation. All right, so in finance, any deviation from our expectation is defined as risk. So traditionally, we measure risk in financial terms using standard deviation or some measure associated with standard deviation, which is a measure of average deviation from our expectation. Okay? We might, for argument's sake, also try to account for returns by using a coefficient of variation or Sharpe ratio. Okay, but our core risk measure is that simple standard deviation measure. It measures the sum of squared deviations from our expectation. Systematic and unsystematic risk are said to be the two constituent components of overall risk. So total risk, as measured by standard deviation, is made up of systematic risk and unsystematic risk. Okay? Systematic risk is Yeah, so exactly. So systematic risk is risk that impacts upon all market participants. It doesn't have to impact upon them equally, but it impacts upon them all. Quite frequently in finance, we use beta, the equity beta, as our measure or proxy for systematic risk. All right? The higher the beta value, the greater the evidenced systematic volatility. Okay? Unsystematic risk is firm-specific risk. Firm-specific risk. It's management-specific risk and industry-specific risk. So what do we do to account for that? Well, it's much more challenging to account for. Some people try to look at the difference between, for example, a beta measure and overall risk, try to create some sort of proxy for unsystematic risk, but it's an unsustainable strategy. More often than not, we talk about it more qualitatively. Okay, so firm-specific risk is generally discussed in a slightly more qualitative way. Modern portfolio theory asserts that we can diversify away a particular form of risk. What does modern portfolio theory say about systematic versus unsystematic risk? Exactly. So you'll find many textbooks talking about the fact that you should only be rewarded for risk that you have to take. That notion comes from modern portfolio theory. Whether you agree with it or not is a discussion for another day, but this is the core of diversification theory, also known as modern portfolio theory. It asserts that through the bringing together of assets that are not perfectly positively correlated, to put it another way, if you put assets together that do not move in the same direction, do not move in lockstep, you get a diversification benefit. That could be one way to put it. Yeah, you try to achieve some sort of balanced outcome in terms of your portfolio. But the key thing to remember is modern portfolio theory asserts that you should not be rewarded for risk that you don't have to take. So you should only be rewarded for the degree of systematic risk that you take. The combination of assets that you bring together should only give rise to a reward in systematic risk terms, not in unsystematic risk terms. And this comes from another very simple Nobel Prize winning paper that identified that the bringing together of as few as 20 assets selected at random from any major bourse or exchange will give rise to a substantial diversification benefit. The majority of unsystematic risk can be diversified away by bringing together as few as 20 securities selected at random from any major bourse or exchange. That isn't our goal, to use randomization to construct portfolios. It's just a way to explain the theory, that you can get rid of the unsystematic risk component through diversification. Systematic risk is not something that you can diversify away domestically. All right, so this is often the associated beta-style question, something that orientates your thinking to beta values and interpreting betas. All right, so an investor holds the following stocks in a portfolio: Oka Limited 5,000.7, Techno Limited 7,001.2, Megabank Limited 9,000, beta 0.8. Explain the beta coefficient for each of the above stocks. So I know I've used this example quite a few times. I'm just going to do it one more time because it'll guarantee that you remember this in your exam. Beta is a slope coefficient. When you were in high school and you drew a scatter plot of observations relating to two things, and you drew your line of best fit through that scatter plot, beta is the slope of that line. Remember, correlation coefficient measures the closeness of the dots to the line. Beta measures the slope of the line. So it's measuring magnitude, okay? And it's mathematically associated with correlation coefficient, okay? Beta is, in fact, correlation coefficient multiplied by relative volatility of asset to market. That's mathematically what it is. The slope comes from relative volatility. The direction comes from the Pearson's correlation value. To put it far less technically, beta measures the relationship in magnitude terms of a change in the market on any given security. And that's the key thing that you need to remember. So beta is not bounded. It can be very, very high. It can be very, very low. Beta can also be negative. All right? You can have negative slope, can't you? Right? Yes, a couple of textbooks that I read in the undergraduate program didn't say that. All right, it's very funny. It's going to be so something to be mindful. It's one of those foundational concepts that sometimes, it's easy to misinterpret. So what does the beta coefficient represent? What does the beta coefficient represent? If you see a particular beta value, what does it signify to you? Systematic risk, systematic volatility. Because it's a measure of how much historically this security has moved relative to the market for every given market movement. All right, so the average beta is 1. You're always going to be interpreting it relative to 1. So if a beta is greater than 1, it exhibits greater systematic volatility than the average. For every 1-point movement in the market, there has been a 1.2 movement in security. Okay? That's the way to interpret it. A high equity beta signifies a security that we would describe as being very pro-cyclical or very pro-market. Okay? A security that is historically up when markets are up. Okay? I like to think of an example in each category. That's what used to help me try to articulate a response. So a security that's up when the market is very, very up. An example would be Miller's and Coors Beer in the US, 2 of the highest equity betas of any security in the world. Okay? We in Australia, we have more refined taste. So the equity beta of our beers is a little bit lower. All right? When markets are up, we drink wine. That said, we have high equity betas evidenced within other securities in the Australian market. So certain consumer durables that are particularly popular when markets are up, obviously certain high-end Australian luxury brands that do particularly well when markets are more up. Okay, so when you see a high beta value, that's what I want you to remember. Okay, greater systematic volatility than the average. The beta value should be considered relative to 1. So for every given market movement, what is the equivalent movement in this security historically? What does a beta of less than 1 signify? That's exactly right. I don't want to say opposite, but a beta of less than 1. A beta of less than 1 is negative? Sorry? Yeah, it's just less risky than the market average or the market historically, but it has to be less than 0 for it to be negative. All right? So what we would suggest that security is less responsive, more defensive. A security with a beta of less than 1, but greater than 0, exhibits less systematic volatility than the average. We might even describe it as being, if it's close to 0, a non-responsive or defensive security. These securities are sometimes good securities to invest in when there is great volatility in the market, inherent uncertainty within the market. Okay? So that's the key thing to remember. How do we go from these beta coefficient values to our portfolio beta? Well, we've done this one a couple of times. All right? All we need to do is calculate our total portfolio value, then calculate our individual portfolio weights. Beta is a simple weighted average. Think about what you're doing. You're adding lines. Okay? It's not a correlation measure. Okay? It's not a covariance measure. It's a slope. Okay, so it's aggregative. You aggregate the individual lines to find your portfolio beta, your portfolio slope coefficient. That's what we're doing here, multiplying the weight by the individual beta to get our weighted beta, and then finally our weighted average beta. All things being equal, as you add assets to a portfolio, at random, the value will approach what? Will approach 1. That's the logic behind modern portfolio theory. Okay? Your portfolio starts to resemble the market, you start to diversify away unsystematic risk. Even though we're not commenting directly on the unsystematic component, we're evidencing how random selection or even non-random selection can give rise to a beta that approaches 1, approaches the average.
We can't compare beta between
Oh. Look, generally people people, when they do talk about a beta value, they generally do engage in that style of comparison. It is a bit inapt, and I do see where you're coming from. Ideally, beta discussions are a little bit more isolated than that, but yeah, for all intents and purposes, people do compare betas across bourses and exchanges. Ideally, if you're looking at a particular pool of securities, you might construct a hybrid market proxy and then construct your own beta values within that hybrid market proxy. But yeah, it's a discussion for another day. But it's a good question. People do. Everyone does, without generally making those adjustments. But they should. All right, so next question is a simple dividend valuation question. It's quite common to get a question involving some sort of fixed rate or variable rate. You need to be able to account for both scenarios. You also need to be able to account for a scenario involving a perpetuity, like a preference share arrangement. Okay? What do you do under each set of conditions? For those of you that are doing the other finance subject, you're probably going to be encountering this twice, so I do apologise. There is a little bit of overlap in terms of this area across both of those subjects. All right, so valuing shares using the dividend discount model. So this is the standard dividend discount model, all right? We sometimes refer to it as the standard model, okay? Just want to go through the notation very, very quickly. P0, P subscript 0, denotes the price today, the current price, okay? D0 denotes a dividend already received, okay? A dividend already received in the current cycle. We need to actually find D1. So we use D0 multiplied by 1 plus G to give us D1. Okay, this can sometimes confound people because some questions will say the last dividend received was. Other questions will say the next dividend received will be. Other questions will say the next dividend will be 10% higher than the last dividend. So you need to be able to just account for that. I think it's very hard to make a mistake outside of dealing with the dividend structure. Every other aspect is kind of given. All right, but when mistakes are made, they're generally made with that D0, D1 value. So if a dividend is to be received, then it's D1. If a dividend is already received, then it's D0. All right, so in this calculation, we have a company. The share has just paid a dividend of $1.80. The rate of change in that dividend value is 8.5%. The required rate of return is 20%. I think we did this one a few weeks ago, so you probably already know the answer. If the market price is $15.50, should we acquire the security? So dividend multiplied by rate of change divided by the required rate of return minus the rate of change gives us a value of $16.98. Quite frequently, the question will actually ask you to interpret what you've calculated, okay, and what it actually represents. Okay, sometimes candidates encounter difficulty with that. You need to appreciate this is not a market valuation, this is not an earnings-based valuation. This is a valuation based on declared dividends, which means it's an intrinsic valuation. A valuation based on actual economic benefits flowing to you, actual cash flows. All right? A couple of things that we already know. Earnings-based models are generally considered superior. If they weren't, well, then Apple and Amazon shouldn't be terribly valuable companies for all intents and purposes. So earnings models are vastly superior. But with that said, this is still our worthwhile starting point. The other thing that we do know is that the intrinsic valuation that we've calculated is based on a set of assumptions. In this case, a very limiting assumption in relation to the rate of change. Is that assumption an accurate representation of the future? So our intrinsic valuation is simply a valuation based on projected cash flows and nothing more. But it can still guide our investment decision making. If we believe our assumptions to be sound, then for all intents and purposes, it may be worthwhile buying this security. Which model? Oh, okay. So that model is more of a model to represent interest rates and inflation. This is a model more useful when valuing a share. So different applications. Yeah. All right, so some bond valuation now. Okay, and then we're going to talk about the associated theory. So, calculating the price of a bond. Okay, I'm not giving you the first part, but that's still enough information. All right, so we have a bond. It should actually list the initial price or face value as being $1 million. So my sincerest apologies, I've taken out the first half when I put this together. Okay, so a bond with a face value of $1 million and a market discount rate of 12% and a coupon rate on this occasion of 13% is the security that is to be valued. My sincerest apologies, you are missing two parameter values there. That's entirely on me, so I do apologize. If you could record the coupon rate as being 13%, and if you could record the face value as being $1 million for your records. All right, so a bond with a face value of $1 million, a market discount rate of 12%, and a coupon rate of 13%, with exactly 6 years to maturity, is the security that we are to price. How do we go about pricing it? Well, this is the formula that you're provided with. It's the SEC RBA formula. You will note that there are other versions out there. Those of you that are doing finance will likely have seen a slightly different version, where the interest factor is brought to the front. Okay, mathematically they're both the same. So C is the coupon dollar value, not the coupon in percentage terms, but the coupon dollar value. We multiply the coupon dollar value by our standard annuity formula. Coupon dollar value, standard annuity formula, 1 minus 1 plus I to the minus n on I. This formula is provided to you. To that we add the present value of the principal sum. In doing the calculation, you'll note that it's a very, very quick one. Obviously, you can do this even more quickly on a financial calculator, but please make sure you record your entry values in full. So 1 million is multiplied by 1.06 to the power of minus 12. That gives us the present value of the face value component. Present value of face value component. To that we add the present value of the annuity. Present value of the annuity, which is 130,000 annually or 65,000 semi-annually. Okay? That's the thing to remember. You need to make an adjustment to account for semi-annual compounding. Just a couple of quick things to be mindful of when doing this calculation. On your formula sheet, the formula is presented in that way. Okay? It's a very quick way for me to know that people have not really looked at this before, is that they calculate only half the answer. Okay? That happens quite frequently. The formula sheet breaks down the valuation into 2 steps. All right, so again, I know I've said it a few times, I'm really wanting to emphasize, you only use the coupon rate to find the dollar value of the coupon. That is the only application of the rate. The discount factor is the variable that will change across your questions. You might be required to value bonds under different discount conditions, under different market conditions. In all of your questions, you will have a very defined interval. There will be no 1 plus I to the k adjustment. Okay? There'll be a defined interval term. Sometimes when people do their year counts, okay, I've been getting a few questions about this by email and discussion. When people do their year counts, they sometimes simply look at the difference between start year and end year. Okay? So, if for argument's sake you're doing a year count, Okay, and you're looking at the difference between 2007 and 2011, you need to actually account for each set of intervals in those years. Okay? A lot of people count it as 2008, 2009, 2010, 2011. Okay? Because they're looking at the differences between years. 2007 to 2011 is 2007, 2008, 2009, 2010, 2011. Okay? Very easy mistake to make under exam conditions. Okay? You're not looking at the difference between the first number and the last number, you're looking at the total number of years, inclusive of the first year, if there are two intervals in that year. Okay, so undeniably the most commonly made mistake will be in terms of this discount rate being used interchangeably with the coupon rate. Please do not make that mistake. All right. So what we might do now is actually have a quick break, and then, did I put that note about that website up? Oh my gosh, I've taken that website down. All right, please disregard the note about these virtual exams. Okay, we don't offer them in virtual form anymore. People were asking for them in other subjects, and other people didn't know how to do it, and it created lots of complexity. So the only exams you get are now in analog form. Okay? My sincerest apologies for that. All right, we might have just a quick 15-minute break. We'll get back together and we'll do some exam papers again. Okay? All right, I'll see you guys back here in about 15 minutes. When did you say you sent me an email? About what? 21 days after the due date, so 3 weeks. Yes. Yeah. You have lots of time. So what happens is it opens it up on the page. So you have to scroll up and you'll see it on your page. And then you just go into it. Yeah. Are you working here? All good. I'll show you after. Okay? There you go. Oh, look, you've got notes and everything. Isn't that good? No, it's good. Very good. Loanable funds theory. Yes, that's perfect. If you do that, that's great. No, that's fine. You're thinking of loanable funds theory. Loanable funds theory generally helps to have diagrams. That one. That's different. Yeah, that's loanable funds theory. You don't have to use diagrams with that one. It makes sense. It's much easier. With the other theories, you don't really need to. Maybe with market segmentation, but not really. But with loanable funds, it's much more conceptually difficult without the diagram. But you don't have to with any of them, unless the question asks. Pure expectations, market segmentation, liquidity premium. Most certainly, but yeah, but that's again one of those things. It's not really the question. It's a little bit broader. So pure expectations theory says that there is no benefit through short-term speculation in different durations, different maturity classes, right? So you could say that in the context of pure expectations theory, but if you just said it generally, then it would not really be adding too much. But to be honest, that's great what you've written down. I just read it.
I just have to keep this in my mind.
No, it's great.
I need to
They're good. That's literally if you can replicate that under exam conditions, you'll be kicking butt.
yeah, I know. So I need to do that in exam.
Yeah. But you wrote it down perfectly. I didn't. You wrote that previously, obviously. I didn't tell you that.
No, I was just trying to
Yeah. That's good. The theory, I think, is harder than the calculation stuff. Calculations are easy. Yes. So the yield curve, that's just a general discussion about yield structure. So sometimes we talk about the direction of the yield curve. You know, that's the only.
So I can explain about that.
So yeah. So the yield curve, right, is explained. The structure is explained using loanable funds, or pure expectations, or market segmentation, or liquidity premium. Yeah, that's how we explain that. We explain that using these. So that's the starting point. We're looking at the yield curve, and then we figure out ways to explain it. And so and then the 4 ways we explain it.
Oh, so I do that like that.
If you want. Yeah, but I would say that if you remember that alone, that I would give you a perfect mark for that. Yeah.
Thank you.
Okay, no problem. But that's the number.
But I think this particular minimum,
Always
it's always
4% for tier 1, 4% for tier 2, 8%. No, I said this is yeah, but I can't be just each up on
No, I guess.
I didn't give you those 2 parameters.
Right. One is
That was my fault.
semi-annual, and the other one is the actual.
I slide. You have to after one.
Exactly.
There's a slide that's showing it.
Alright, so with respect to that, the only
No, nothing more. How you going? Yeah, I'm good. Good. Getting on.
Sir, is Bitcoin's good?
Bitcoin good.
Market.
At the moment, not at the moment. Maybe about 5 years ago. Why are you looking at Bitcoin at the moment? Are you?
As we discussed.
I know people that make money through short-term speculation, but that's like any commodities market. It's just like any other commodity at the moment. There's a lot of risk though.
Yeah.
You know, I take care with that.
Actually, I discussed with that my cousin, he wants to invest some money for short-term purpose. So what would you recommend?
Oh, not that. Not that. If you want to see some good investment advisors, I can introduce you to some, but they're not going to be talking to you about Bitcoin. You can make good returns on that investing in Bitcoin. Yeah, if you're investing in that, I hope your cousin likes you a lot. If you're telling him to do that. All right. No, I'll talk to you. Happy to. I can put you on to some people. It's no problem. Yeah, as I said, I didn't include that slide. That's my fault. Yeah, I said, please write down 1 million semi-annual and 13% because I didn't give you those numbers. It's missing one slide. It's my fault.
Yeah, it's okay. And this example, 1 year period twice?
Correct. Yeah, but I'll add that slide as well so you have it for your records. But there should be one slide that says semi-annual face value 1 million. Coupon rate 13. You don't have correct. It was my fault in putting this together. Yes, of course. Most certainly. Sorry?
Is it here office reason?
It's all regulated.
Oh, it's, okay.
It's all centrally.
Oh, right.
We have any local control on it. Sorry. Obviously we can't pay out anything. 2,000 students.
Yeah.
$5 million surplus, yeah. Hard to pick. Yeah. Deacon is kind of going the other way to everyone else at the moment. I'm not sure ways we've been able to scale. I mean, it's a good thing to an extent, but goodness knows, some of the cohorts are getting very, very large, and being able to kind of actually have rapport with people is really changing. So, that aside, it's been good for the university. Gosh, some of the others. Look pretty, yeah. And you can certainly see that there's a really sort of strong emphasis on the building program at the moment. They've also invested really heavily, especially created an additional professional services unit that created a new digital licensing program for all the technology we've built. So they've actually started a licensing program for the Americas. So DPG, Scout, all the platform tech is being deployed in a number of universities there. As part of the grant plan to control the ecosystem. Yeah. It's interesting times. But I do apologise about the heating though. You're not the first person to comment though.
You had some stuff to send me about AI.
I do, and I also have a conference that's coming up that I was going to get you some tickets to if you're keen. It's actually my accounting type. I know a whole heap of AI executives are always going to undertake people around these issues. There might be some sort of way to do that in some sort of dedicated program for them. I think both of the major associations are well and some of the smaller associations what's happening.
You can just send me an email, maybe you
To get the dialogue.
Yeah, that's right. Just to get people to break out and break away from spreadsheets and stuff.
One of my bosses spoke at Zero Column. I also spoke at Live Plus last week. Zero 2 weeks ago. And the keynote of both sessions was the role of, I guess, the information age, the role of knowledge work. Zero was really centered around the growth position. So actually, two programs that they're actually making their customers out but they're actually still going on further. So it's one party that's providing as well. So rather than it being a party solution, they're actually trying to provide an integrated workflow. Processed. No, most certainly.
The rest of the business seems to be US and others like evaluation.
Most certainly, I think that's really what the presenters are trying to do. They're also trying to encourage the members, questions that are we're going to control the platform. The platform is going to be running high level execution around transaction variation, around alternative reporting, around data dissemination. And so we're not going to be able to GL level. We're going to be much more involved. I'll certainly pass it through. Oh, SMEs are a tough one. Is it? It tends to be quite category specific. Look, I'm one that learnt a great deal from Damodara, so most of my modelling approaches are probably quite heavily influenced by him. But Ashworth Damodara,
So he's considered kind of the doyen of modern financial modelling. So he's a professor of econometrics and financial analysis at NYU, but he's also, I guess, in terms of like prosumer modelling, he's probably one of the lead sort of academics and thinkers in category. So I can send you a lot of his book. I have a few of his books as well that are available on our platform that you can read. But when it comes to SMEs, it does tend to be very, very case based.
Because it looks like somebody sort of just goes down the
Oh, undeniably.
really does it.
All with uniquely challenging companies. So one of the things that we used to do early days in the program was get people to value Amazon. It's such a great company to value because it's so hard to value.
Not so much.
No, but early days, like first 5 years, first 7 years, it was making nothing. But it was clearly on a road to something truly remarkable. And we could all see it, but actually creating a model that represents that value is very, very hard, super difficult. So it used to be a big part of what we do. We're actually doing, are you interested in valuations? So one of my friends is the head of Umere, which is a valuation certification group, and they're doing a whole heap of certifications. So if you want to do their certification, I have free passes. It's normally like $400. If you're interested in doing it, it's predominantly Excel based, but a really, really good, intense model. The problem is it's much more, it's broad modelling technique for level 1 and level 2, but it does sort of teach a lot of best practice and very influenced by Damodaran. They run a competition, global modelling competition. The prize is $100,000, and the judge is Aswash Damodaran. So it's worth doing. It's worth doing. He's a lovely lad. They'll fly you up to New York for the finals and everything. So. No, but it's not too many people are interested in the modelling side anymore. So if you are, more than happy to do that. Just shoot me an email and I'll send you the coupon code. But in terms of what we do, we're doing some SME valuation seminars over the summer. Yeah, so we have an executive education program, and it's not free, but whenever we do seminars, we're allowed to invite people. So. It's because we can get a little bit more high level with it, more so than we can here. We kind of stay at dividend models, level 1, and eventually go through a full earnings valuation based on earnings data. We use Monte Carlo methods, use data science, more modern data science methods, and also traditional methods. So you kind of get three different approaches for your toolkit. So, cool. Most certainly. It's very arbitrary, very arbitrary. I'm not going to pretend like it doesn't happen out there still. I'm not going to pretend that it doesn't, because it really does. Ooh, you said you. Oh. No, most certainly. No, look, it's good to meet someone like yourself who's obviously keen on this stuff, because more than happy to sort of introduce you to these sorts of things. And as I said, for Calvin, Rahul, and a few of the other guys that got into them, it was kind of a journey to sort of next iteration of their career. I guess in your case it's a little bit different because you obviously have really, really good modelling and mathematical acumen already. So it's probably a little bit more contextual, I guess. So you can take opportunities to contextualise things and sort of setting relevant type methodology. But I'd still say it's valuable. Yeah. But what I like is that because most of what we do is Excel based, it's really focused on sound fundamentals. Obviously we do focus on slightly more high level approaches just because you need to give people those tools for their toolkit. But the reality is, when it comes to these sorts of enterprises, you really can't use data-driven approaches because you lack the data to do it. So it becomes quite clandestine, but it's kind of good because it means that a computer can't replace you. Do you know what I mean? Like, you want that value add. Oh. It's not conducive to it. Yeah. I am for a bit. I am for a little bit, but I unfortunately have to do a couple of conferences today too. So I'll be there for a while though. So if you want to catch up I'll be there for about an hour. Yeah. calculations. I'd say so. I'd say, look, the challenge is always trying to get your hand around a lot of things. It's a lot of breadth at this stage, but give it some time. You need to actually just go through the slides one by one, tick them off. Literally, the 2 revision decks, tick them off, slides one by one, and you'll feel a lot better about it. But we can get together too. There's still a few weeks. No, all good. No, happy to chat. It's just today, just today. Any other day will be fine. We can chat for at least an hour. All right. So let's make a start. Just before we proceed, a couple of things. I want to talk about this now just so we can kind of get into the alternative headspace and then get back into revision headspace. But really just want to encourage you guys over the summer to really start having a strong think about your certification path, about what you're going to be doing next. All right. So I know that for many of you, you come into the program and you're probably a little bit undecided about what you want to do. It's the nature of a generalist business-based program. When you enter into the program, you probably have a broad trajectory, but it's now important to actually start thinking about refining that trajectory a little bit, and thinking about what you want to do next, and being aware of all of the opportunities that kind of sit in front of you. I will concede that it's a lot to think about when you are studying full-time, but it's important to think about it now. So, again, really wanting to highlight the fact that there are lots of gratis or free certifications that are available through the university over the summer. I've arranged with organisations like CPA Australia and a number of others, in addition to the ICB and a few other groups, to actually offer some credentialing sessions and certifications around business modelling, data science, and in particular certain versions of Agile. Depending on individual preference, there will be a few different versions of Agile style framework-based accreditations that will also be available. Okay, so I'd encourage those of you that are interested in some sort of certification in data science or, for argument's sake, data modelling, financial modelling, or perhaps BA style certifications to reach out. I am going to put some details on the cloud about this, but I'd love over the course of the next couple of weeks to get a really good capture of how many people from this group are interested. I have expressions of interest from T1 groups and past T3 groups as well, so I'd really like to, again, just try to figure out what we can and can't do based on expressions of interest. So the sessions that we'll be doing regardless will be some of the sessions around certain project certifications. But there are some more specialist opportunities that I'm uncertain about and I would love some feedback about. I will concede that there are some people in this room that I've never seen before. So for those of you that I've never seen and never met before, well, first of all, lovely to meet you. Secondly, this probably goes doubly so, for you guys, because you probably haven't had the benefit of my meandering diatribe over the course of the last 10 weeks about the importance of credentialing and certification in the modern knowledge economy. So I'm just really going to emphasise that point again. Please do feel free to reach out. I'll let you know what's happening, what's on, what you can access. You can start to credential and accredit the skills and competencies that you have, such that the third-party employer can actually look at your CV or some sort of summary of credentials and figure out where you might fit within their organisation. Okay? For those of you that are from a more accounting bent or from a more management bent, there will be something in it for you as well. I've spoken to these bodies about running credentialing sessions around green accounting, carbon accounting and that sort of thing. But beyond that, also looking at more high-level value add from an accountant's perspective. So looking at how you might be able to bring value beyond record capture, how you can bring value through analysis. So we are looking at doing two certification sessions in the main professional bodies in November, during the first week of November, which I'll avail you to. But there could potentially be more opportunity if there is sufficient interest. All right? I know a lot of you guys are probably thinking, well, I'll have a master's degree, or possibly 2 master's degrees. And I'll say, wow, that's really good. I'm really glad and really happy, but I want you to actually succeed in the real world and in the competitive environment that you're going to enter into. It's really important that you look just beyond your grades. I know that sounds terrible. Gosh, why is an academic saying that? Because it should all be about getting a HD. Of course, everyone wants to get a HD. In fact, I want you all to get HDs. Okay? My last 3 groups, I put it to them all. All of you get a HD will make you look like the greatest educator in the history of this university if you do. All right? So I'd still love for you to do that. But if you don't, and you're career focused, I'll be equally happy. If you're pursuing some gainful employment opportunity, if for argument's sake you're actively credentialing while concurrently studying, I'll be even more happy. Okay? So can you guys please reach out? You have my email address, you have my contact particulars. I will post all of the confirmed session information as well as the tentative sessions. And you guys can offer me some feedback as to whether there's some work in it. All right. Now I've done right by you. The ball is in your court. What we're going to do just to finish is go through the weekly questions. We have done this course already, but I think there's still some value in really highlighting some of the more important questions, in particular the theory questions. Okay? So that's what we're going to do. And I will also furnish one further sample exam paper. Again, please disregard the note about it being available in digital form. Unfortunately, we're not doing that anymore. We may well do it in the future, but we're not doing it at this point in time. So it will just be an analog version that you can print out and answer in your own time. All right, so in topic 1, it was very much an introductory session. We covered up a lot of generalities, and we discussed the role of the Reserve Bank and the Central Bank in particular. So question 2 and question 5 were the most important questions. They were covered very, very briefly at this stage. We expanded upon those discussions in week 7 through week 9. Okay? Let's take a moment now and just consider them one more time briefly. All right? So questions 2 and questions 5, we'll consider them concurrently. The other questions are rather broad. You can read them independently should you choose to. So what is the role of the Reserve Bank, Central Bank, within a financial system? Okay, so you were required to explain the role of the RBA, SEBI, the Chinese Central Bank, the US Federal Reserve. How would you go about explaining their role? Sorry?
They monitor the bank, they fix the cash reserve ratio.
Okay, undeniably, yes. They moderate the reserve ratio. But if you were to actually put together a set of postulates or principles that would explain to a third party the key activities of a central bank, what would they entail?
Regulating the monetary policy.
Undeniably, number 1, regulating and implementing monetary policy. That is, for all intents and purposes, why central banks exist. All right? The key role of the central bank. What is the ancillary role relating to that? To implement monetary policy, you also need to have control over another key system. What is that system?
The money available in the market.
Yeah. Undeniably, what's the system though? We use a payment system. The payment system. The Reserve Bank moderates the payment system. So, in terms of setting the reserve ratio and also setting the holding ratios in relation to the payment system, the Reserve Bank does that. So you were well and truly on track with your answer. Okay? The payment system is integral because it facilitates exchanges, value exchanges, between the major registered financial intermediaries within the financial system. Beyond that, there are 2 other key ancillary roles. The Reserve Bank retains the discretionary right to intervene in the market to influence the currency position. Okay. And the Reserve Bank engages with the market in terms of buying and selling behaviour, not just to influence inflationary pressures, but to also influence overall economic activity. But three key roles, and we can also discuss a number of ancillary roles. Okay? Further ancillary role works with the Australian Office of Financial Management for the issuance of currency. That obviously is part and parcel of this currency role. So if you're trying to think of things you can draw upon in your exam, think of monetary policy, payment system, and currency. Monetary policy, payment system, and currency. Okay, question 5 is probably one of the harder questions in the program. We only covered it briefly at this stage, and we cover it on a call later. No time like the present, and let's cover it off on it in full now. How does the Reserve Bank impact upon the actions of economic agents within the financial system through monetary policy? Okay. Monetary policy is complex, as I said, it used to be, in most undergraduate programs, a full 12-week course. All right? Now, because of all the modern academic disciplines, it's been displaced. All right? So you don't get the benefit of that. You get the benefit of half a year you sort of know. So, great thing about monetary policy. A lot of complexity, a lot of nuance to it. But there are only really two things that a Reserve Bank can do in response to any set of economic circumstances. All right? Only really two things they can do. It's one I want you to kind of keep in reserve. Okay, the Reserve Bank can only buy government securities and reduce the supply of money, or sell government securities to reduce the supply of money, or buy government securities to increase the supply of money. Okay? So it buys securities, it increases the supply of money in the system. It sells securities, it decreases the supply of money in the system. It can only do one of two things. So when we talk about monetary policy, we're talking about the moderation of the cash rate, the overnight interbank rate, through the buying and selling of government securities. Okay? They are the open market operation actions. All of that discussion can be subsumed into buying or selling behavior. All right, so let's consider the scenarios we're likely to encounter when we might need to discuss. If, for argument's sake, inflation was high, that would suggest that the economy might be overheating and the Reserve Bank might want to slow the economy down. How might it slow the economy down? What's it going to do to interest rates? It's going to increase interest rates. And what action will it take? It'll take two actions. Which one? To increase interest rates, it needs to reduce the supply of money. How's it going to reduce the supply of money? Step by step.
By selling the securities like government.
That's exactly right. Selling government securities through an open market operation. The Reserve Bank will enter into the market through an open market operation, engage with the market, and sell securities, thereby taking money out of the system, reducing the supply of money, increasing interest rates, and there should be a slowing down of the economy. Good? Okay. All right. So the other plausible scenario that you might have, I don't give you that many. What's the other plausible scenario? Well, the economy is slow. The economy needs to be stimulated. How is it to be stimulated?
By the government gives some subsidies to the people, like we discussed.
Excellent. That's fiscal policy.
Yeah.
All right. Very good. What about monetary policy? What's the government going to do in terms of monetary policy? This is the great thing, all right? Two sides, one coin. Going to do two things. So what's it's going to buy securities. The market will be awash with cash. Supply curve, we'll see an expansion in the supply curve. We're going to see a decline in interest rates. Interest rate is the price of money. Money is in abundant supply. The price of money goes down. And now the economy economy is stimulated. All right? So when you're talking about monetary policy, you need to explain open market operation actions. Monetary policy is the process of moderating the cash rate and overriding demand rate through open market operations. And there are only two plausible open market operations. Okay? I don't want to hear any hoo-ha about this being really complicated. It doesn't need to be a 12 course. You can get the majority of the theory done over the course of one session. Yes, there are nuanced interaction effects with other economies, the availability of funds abroad. We can talk about those interaction effects on how to manage that all down. But they're the two key interactions and the two key effects. Okay? All right. Talked about securitization already. Okay, key theory questions. I'm trying to be a little bit more focused. I know you don't want to cover off on everything at this stage. I appreciate where everyone's at. Okay, we'll have a look at question 3, and then we'll have a look at question 5 on this page. Question 3 and question 5, as they relate to banking and NBFI activity. So what are the key differences between asset management and liability management in the context of modern banking? Asset management versus liability management. The words say it all. Okay, so in Australia, over the course of successive decades, as a result of the amazing work, I won't hear anyone speaking negatively of them, of the Hawke and Keating governments in this country, we saw major deregulation to our financial services sector. No, it's okay, I've just decisions. People have different views on these things. That program of deregulation gave rise to some initial challenges and some subsequent benefits. There was a substantial regulatory program in place initially that caused banks to become less competitive. And NBFI market share grew to over 25% of the sector. It was huge. Okay. So non-bank lenders were actually capturing substantial market share away from banks. The more competing government there was a message of no, we need to deregulate the sector. We need a more vibrant and vibrant banking sector. And as a result of that, they actively deregulated. They allowed the banks to engage in certain activities that they weren't previously allowed to engage in, and competition was encouraged and stimulated. Concurrent to this, there were substantial advances made in computing during that time. Okay. Prior to deregulation, as a result of limited computing systems, banks weren't very encouraged or incentivized to engage in risky lending. So they took what we would describe as a very asset-driven approach to lending. What does that mean? It meant that they were driven by the available assets on their balance sheet. What assets they possessed governed how they would lend in the future. Okay? So they didn't engage in risky lending. They didn't go into the wholesale market. They didn't issue new securities frequently. They didn't access wholesale market opportunities from foreign partner organizations or affiliates. They just lent what they had. I'm not going to make a joke about, 2% yield at 2 o'clock on, everyone heard that joke? The golf course. I mean, it wasn't really that bad. They were actually truly remarkable individuals because computer systems weren't quite getting the world itself. With that said, with the availability of modern computing systems, banks took a far more liability-driven approach. If they would go out into the market and identify market opportunities, they would also seek to back those opportunities by looking at how they could take on liabilities, how they could borrow in wholesale markets, how they could work with affiliate networks, how they could work with foreign bank partner networks to access the capital they needed to make the loans they needed to make. All right, so that they weren't as conservative. So it was a shift from asset-driven lending to liability-driven lending. All right. All right, question 5. I know that you all know this. You just have to be with me because we are required to include questions on regulation. So please be mindful of that when you come up from time to time. I have given you core emphasis items, but it is worth Let's take a moment and consider the major regulatory agencies in Australia. We talked about it a couple of weeks ago. Just a question that came up on a past paper. Which regulatory agencies are the main regulators and moderators of banking activities within Australia? So this question requires you to articulate the role of each of the major regulatory institutions and their role in particular in relation to banking. Let's consider them: the RBA, APRA, the ACCC, and ASIC. In the case of the RBA is the central bank. It also moderates the payment system. So its role in the context of banking is critical. Okay, it facilitates repurchase agreements with banks and supports intraday liquidity through those repurchase agreements, as well as facilitating the payment system. ASIC is the key securities regulator. So all securities issued by banks and by all institutions for that matter are approved by ASIC. Okay. APRA is arguably the most important institution you would need to talk about in the context of this question. APRA is our key prudential regulator. They deal with the adequacy of the bank's liquidity position, its capital position, and its operating procedures. For all intents and purposes, APRA moderates the Australian implementation of each of the Basel Accords. All right. Finally, we have ASIC. Okay, ASIC deals with ACCC. I've already said that. Gosh. The ACCC. The ACCC deals with competition in the context of banking, and they probably have the smallest role in the context of day-to-day banking, albeit they do moderate competition policy and the way in which the banks engage with the markets in terms of marketing. They also moderate the four pillars policy, which precludes the merger of any of our major banks. And they also need to provide approval to any major banking sector acquisition. I guess technically speaking, there are a couple of others if you want an extra credit, which doesn't exist. You could talk about the Bank for International Settlements as an alternative to any of those. You can also talk about the formulation of the Basel Accord. And you can also talk about the Foreign Investment Review Board, which deals with any major acquisition of an Australian institution. So from time to time, Australian banks are the subject of acquisition interest. That's always reviewed by the Foreign Investment Review Board. All right. These ones you can look at in your own time. Again, I have explained the emphasis of this trimester. Okay, so we've talked about a couple of these already this morning. Let's do item 4. Okay, item 4 was one that I skirted over before, but I dare say it is an important one. So in the context of interest rates, and the explanation of interest rates, how we go about engaging with discussions pertaining to interest rates, there are a number of different theories. Today we've talked about pure expectations theory already. There are a few others. We have market segmentation theory, we have liquidity premium theory, which builds upon pure expectations, but we also have an entirely separate theory known as loanable funds theory. And I spoke to one of you briefly about it before. This is the fourth theory. Okay? The loanable funds theory of interest rates is arguably the most complex because there are a number of different elements to the theory. It's perhaps best understood with the benefit of some diagrams. So I might just pull up the diagram just for the benefit of our discussion. The loanable funds theory of interest rates asserts that interest rates are a function of supply and demand. However, supply and demand conditions are not consistent with traditional supply and demand functions. There is some subtle variation. So all demand for funds is said to derive from business and government. However, government demand is assumed to be inelastic, which means that it's non-responsive to variation in interest rates. We combine an inelastic curve with a traditionally uniformly elastic curve, uniform in the traditional sense of being uniform, a downward sloping curve, we end up with a function that is inelastic as well as being a traditional function beyond a particular point. So, what does that mean for all intents and purposes? It means that at a particular point in time, all demand will actually derive from government. So under extreme rate conditions, within extreme rate scenarios, when rates are very, very high, only governments will borrow because it's prohibitively expensive for everyone else to borrow. Okay? Is that true in the real world? To an extent, it's true, but not entirely. This is a simplification. All right? Businesses will borrow even under extreme duress, under extreme circumstances, within high-yield environments. Equally, governments don't always borrow. Governments do not borrow when yield structures are very, very high for particular projects. Consider, for example, funding infrastructure projects. Infrastructure is more consistently funded within low-yield environments. Have a look at infrastructure being funded now relative to infrastructure projects that were funded in the 80s, for argument's sake. So people do think pragmatically about long-term borrowing. Governments do. But this is the function. Downward sloping plus inelastic equals a combination. Okay. What about supply? Supply is said to be a function of three interactions. You supply from households through traditional supply, your depository savings. Supply coming from changes in monetary supply. This is where it links back to monetary policy theory. Supply resulting from a change in monetary policy, an open market operation. Has there been an expansion on the supply of funds? Okay? So your deposits, changes in monetary policy, and hoarding or dishoarding behaviour. Okay? People really struggle with the last bit. They often don't talk about the last bit. All right? Dishoarding occurs at high yields because people are incentivized to take money out of grey markets, they're actually black markets, and put it into more appropriate markets. That does happen. Okay? Good case in point. What happened in India in recent years? Everyone remember demonetization? Yeah, was that a fun experience? Well, it was quite an extreme experience for many, and it was quite controversial. I received more emails about that than I did anything else. People wanted me to share my own personal opinion. I don't ever share my opinion with any of these things because we all have different views to whether things are worthwhile or not worthwhile. But it's a good economic case study because it just goes to show the substantial quantities of funds that are held outside of formal markets. Okay, so the effects are far more extreme in the emerging world, but they still occur even in countries like Australia. Do still hold money out of formal finance. Okay? So hoarding and dishoarding effects are far more extreme within some countries than others. And so the inflection will vary depending on the country that you're looking at. Okay? In Australia, we're quite participatory when it comes to markets. So dishoarding effects here are relatively small relative to other markets. So key things to remember under exam conditions. Combination of a downward sloping demand curve with an inelastic curve gives rise to a government and business demand function that is inelastic and then conventionally elastic. By that I mean traditionally downward sloping. We then combine that with household supply adjustments that come from monetary supply and hoarding or dishoarding behaviour. Undeniably, the easiest way to respond to a question like this is with a diagram, but you don't have to. Okay, if you get a question on this, or if you're comparing it with another theory, please make sure you consider using a diagram if you remember it. All right. So other important questions from that week. All right. Question 5. Market segmentation theory responds to several assumptions of pure expectation theory, taking alternative position. Briefly explain how market segmentation theory contradicts expectations theory. Sorry about the theory. I can teach all the high-level quant subjects and all the qualitative subjects. None of my colleagues like teaching me. That's actually what happens when you just keep saying this requirements instead. And then people resent you because they think you're teaching them too much theory. No, this is important because you need to be able to compare each of these theories. I hope that you do see the value. Good fundamentals are important. Good fundamentals, everything else So market segmentation theory asserts that the markets, for all intents and purposes, are segmented. What assumption does it invalidate? This is a key point to remember. It invalidates the perfect substitutability assumption, where pure expectation theory asserts that investments are perfect substitutes across the yield curve. Market segmentation theory contends that they are not perfect substitutes because investors have preferences for short, medium, or long term. This is evidenced by investment portfolios around the world. Different corporations have very, very different investment models. All right, so that's the key assumption that is invalidated, the assumption of substitutability of investment. How comfortable is everyone with this set of calculations? Please say very comfortable. Please my concern. My concern now. Honestly, how comfortable are you with it all? I wanted to talk more about theories though. Originally we were going to do an exam related to theory. I've kind of done this a little bit differently. They were covered up on quite a lot, so probably be a little bit overwhelming, but to make sure that you are still comfortable with this. This was an example paper that I thought I would do with you. We have done this together a couple of times already. But I would appreciate your honesty. Would you like to revise an example? Yeah? All right, thank you. So let's do that. I put up a breakdown of one of these questions. We might actually do that together, and then you can revise it in your own time as well. I thought I did. Let's have a look. Okay, there we go. Here are some examples that you can look at in your own time. They cover off on the two scenarios. Where's the other one? Okay, yeah, it's fine. I'll do that. It's fine. All right. So, this is an example similar to the one that was covered off on the class. Please review it in your own time. Just goes through the steps and gives you the equation. Okay? This equation is provided to you in the exam as well. So digressing slightly, we've talked about the theory of pure expectations. Now we're going to do the associated calculations. Okay, we're going to calculate implicit rates based on a set of known and expected rates. We're given the following information. The current rate is 10%. The 1 year rate in 1 year's time is 12%. The 1 year rate in 2 years' time is 13. The 1 year rate in 3 years' time is 13. We are required to calculate the current 2 year rate, 0I2, current 3 year rate, 0I3, and current 4 year rate, 0I4. So you can do this from first principles. That's how we did it together in class using Excel. But this is the equation-based approach, all right, which is, I'm assuming, the approach that many will take. So first and foremost, what we need to do, we need to actually discern which two rates will equate to the rate that we are after, the interval that we are after. The current 2 year rate must be made up of the 1 year rate and the 1 year rate in 1 year's time. So we have the 1 year rate and the 1 year rate in 1 year's time. We want the 2 year rate, 0IN. Therefore, the value that we take as the power, the exponent value, is 1 on n or 1 on 2. We deduct 1. That should actually be like 10.99, 10.98, thereabouts. It's been rounded. I don't know why I did that. Rounding is unhelpful in this example. That's not what I'm actually showing the difference. All right. 0I3 equals the current 1 year rate, the 1 year rate in 1 year's time, and the 1 year rate in 2 years' time. The 3 1 year interval rates that equate to the 3 year rate that we are after, the current 3 year rate. We want the value of 0IN, n is 3, so the exponent is 1 on 3, and our answer is 11.66. How are we all going with that? All good? Would love a couple of questions at this stage. If for nothing else, just to humour me. So just to make me feel like we're having a dialogue. I would love that. Gentlemen with the surface computer, maybe? You're obviously enlightened because you've got an enlightened computing device. It's a good computer. No? I'm happy even with a Macintosh user then. I'll take a Mac user. No? Alright. No, I'm just being facetious, guys. Everyone's thinking at home. With their iPhone, quite resentment. I love this thing. Alright. Please, if you are having difficulty with this, please reach out. I'm more than happy to take calls as much as I need to have how I do my second over the course of the next 3 weeks. Please call, this is important. All right, last question for this section. 0I4, the current 4 year rate, must be met up with the current 1 year rate, 1 year rate in 1 year's time, 1 year rate in 2 years' time, 1 year rate in 3 years' time. We are after 0IN, n is 4, the exponent is 1 on 4. $11.99. Please read this, because I added like little hints and little notes, little things requiring you to think in a non-mathematical way about how to get your answer. Okay, that's calculating the short interval. My apologies, that's calculating the long interval from short intervals. Now we want to calculate a short interval from a longer interval. Okay? So let's say for argument's sake, you're given this information. 2 scenarios that you might encounter. Okay? Short intervals to a long rate, long interval to a short rate. Here we have the long intervals, we need to calculate the implicit rates. The question asks us to calculate 2I2. How can we calculate 2I2 with the given information? 2I2 must be the difference between 0I2 and 0I4. Okay? The 2 year rate in 2 years' time must be the difference between the current 2 year rate and the 2 year rate in 2 years' time. Yes? That's true. Current 2 year rate and current 4 year rate. I explained all 3 relationships in one sentence. Okay. So, this is the formula that is provided. I personally think that sometimes it's easier to do from first principles. This is the same formula as we used a moment ago. The only point of difference is, now rather than solving for a long sequence, we're solving for an implicit rate. So rather than multiplying out, we've divided. It's resulted in an equation where the numerator value is the full interval, and the denominator value is the interval that brings us to that point. That's the easiest way to remember in my view. The notation that you're given in the exam is n plus k. Okay. The easiest way to think about it is the n value is the value that brings you to that relevant interval. Okay, n plus k is the total interval. Okay? As you can see, sometimes it is easier to do from first principles. When we write this out as an equation statement, all we do is we write out the value of 2I2 on one side, and what it equals on the other side, and we solve for 2I2, right? Straightforward enough. When we use an equation, we have to actually think about the constituent components in a little bit more detail. So NIK, or 2I2, must be n plus k4, n plus k4, and n2. The difference between the two. Okay? The difference between one and the other, taking the power of 1 on k, the term of the relevant interval, is our answer. Okay. like I said, I think this is easier, so we're going to do it this way first. The current 4-year rate must equal the current 2-year rate plus the 2-year rate in 2 years' time, the unknown. Okay, all you need to do then is solve for the unknown. So we divide the n plus k value, 0.11, by the n value, 0.09. Okay? We then deduct 1. My apologies, no we don't. We then take it to the power of 1 on 2. We then deduct 1. All right, we need to account for this power first. We take the inverse power. We're left with 1 plus x, we minus 1, and there's our formula. Okay? Alternatively, if we were to take this approach, if we weren't to do it from first principles, what would we do? Well, we would ask ourselves the question, what rate covers the entirety of the period? What is my n plus k value? My n plus k value must be the 2-year value, and the value for the subsequent 2 years, so n plus k is 2 plus 2, 4. Okay? So the value that covers the entire interval is my 4-year value, my numerator. I then try to figure out what my denominator is. I do that by discerning what value brings me to my relevant interval, the value of n, okay, the 2-year value. So I divide 1.11 to the 4 by 1.09 to the 2. I then take it to the power of 1 on 2 and minus 1, and I have my 2-year value in 2 years' time. Or you can use linear interpolation. The other really great way to do this, if you wanted to, okay, you can use simple arithmetic to find your approximate answer, and you substitute it into an equation, okay, and the variation should tell you approximately how far away you are. Okay? That's the way to get an answer if everything else isn't working. It's still mathematically correct, I'll still give you full marks for it. Okay? So you can use linear interpolation with an estimate above or below. You can use a substitution-based approach by just calculating an arithmetic average, substituting the arithmetic average, look at the difference between your answer and the most appropriate answer, which you should be able to discern with the variations above or below, using arithmetic average. Which I'm not going to say another approach, you've got to. That's enough. Oh, sorry, this is the... Yeah, so use one or the other, use either of the approaches. They're both essentially the same. The second approach, below, is just how we derive the formula. All right. How's everyone tracking? Pretty good? I'm seeing a few people not approvingly. So that's good. People that I've not met before, I'm not getting any emotion from. Could mean anything. When we haven't built rapport yet. I'm not sure. I just want to highlight before we finish off just a few other questions that are worthwhile for revision. We might call it a day shortly thereafter. In terms of the share markets topic, okay, the topic 5 material in particular is important. Please, I'm just really wanting to emphasise this. Please disregard dividend imputation or dividend imputation notes. It's not going to be examined. Okay, it's beyond the scope of your exam. Dividend imputation. Yeah, dividend imputation is beyond the scope of the exam. Please familiarise yourself with questions 6 and 7 in particular, because we did devote some time to those. In relation to the fiscal policy, monetary policy and government securities topic, I'd say for all intents and purposes, revision of all of this will be valuable. Okay, so this is this topic in full because it really covers off on a lot of other items. Okay, when it comes to the corporate debt topic, please make sure that you revise the role of credit ratings in the process of evaluating a debt issuance, as well as the valuation of bills and the valuation of bonds. What we've not done today, a number of the applied questions that we covered off in previous weeks related to mortgage instalments, please make sure that you have a look at that as well. But for all intents and purposes, you can disregard the broader discussion in the section. When it comes to the topic on Forex, I think I've emphasised this. The primary takeaway, the key emphasis is on the general euro markets discussion, and in particular the euro bond and euro bill discussion. Right, so you need to be able to explain the distinction that is drawn between different issuance models. How does a euro bond differ from a traditional bond issuance? All of the general conventions and definitions are not within the scope of your assessment. That's the key takeaway from that section. Okay, and I've made clear the derivatives topic is not going to be within the scope of the examination. That means we will not do any option forward future pricing or be examined on any of the associated theory in this iteration of the course. Okay, that's changed since last trimester. It's a pretty good outcome. You start to do fully constructed swaps, and you still also have to do American option pricing. So that's a good miss. But you probably do it in finance anyway. You're doing American options in finance? I think you should be. All right. One of us needs to be covering it, so we'll need to have another dialogue then. All right. Just one other thing I wanted to mention. There's been a few questions about the Basel Accord topic. Okay? Just want to make clear, all of this calculative material in the Basel Accord topic is out of the scope of this year's examination. Outside the scope of this year's examination. All right? So, the Basel Accord material is outside the scope of this year's examination. It's outside the scope. All right. Yeah. So the Basel Accord discussion covered off on Basel 1, Basel 2, Basel 3 in the original Accord. Because of the ambiguity introduced by some of the new Accord releases, it's not being examined this semester. It will be again next semester. The Basel Accords are outside the scope of this year's exam. Okay? People don't believe me. I love when I say things and people don't believe me. That's fine. Please, by all means, review the Basel Accord material. It's good learning anyway. It is. There's a really good section on Basel 3 for those of you that are familiar with it, but we're not going to be examined on it in any exhaustive manner. All right. Just really want to, again, really emphasise the importance of preparation in relation to the theory. Okay, I will provide you with another sample paper. I will be in ongoing contact by email. All right? So please make sure that you look out for that. And also, please start calling if you need help. Now is the time. All right? If you need help with any particular topic, any particular concept, if you're feeling a little bit challenged by something, call or email. You can certainly use the forum. I do know history is any guide. People prefer to not use the forum. If there is something that everyone will benefit from, please use the forum as well.
Like request, is it possible to get like 30 to 35 questions, like all over the site?
30 to 35 questions. Yeah. All the possible questions. I appreciate your candor. I appreciate it. You're a lovely young man. Look, there are rules around what we should be disseminating. It should be no more than 3 exam papers released. I know other chairs do things differently. I have done things a little bit differently this time too by actually telling you areas of emphasis. That hasn't happened before. Okay, so I'm trying to approach the mean, I should say median, in that respect. But what I will say is I can't really go beyond that without sort of maintaining the rigor. We need a level of rigor in that final assessment. And I think you're honest. I think you're a really smart bunch. Don't believe that I've ever said this to anyone else before because I haven't. I think you're quite literally the smartest bunch of people I've ever talked to. So that means you don't need all of this additional help. You just need to go into the exam with a degree of confidence and sufficient preparation. I do think there would be some benefit in possibly having some online discussion by, I don't know how confident people are with using like Citrix GoToMeeting, like WebEx or Zoom, maybe getting together and going through some Q&A that way, closer to the final paper. How comfortable are you guys working in a web conference environment? Would that be beneficial? Maybe doing that a couple of times. That I'm happy to do. It's much easier to give you the questions. But I think this is a good middle ground. So we might arrange for some go-to-meeting sessions. Does everyone use Blackboard? Blackboard Collaborate? All right, great. So we'll maybe make some time to do that. Or at the very least, if you would like to do that individually with me, you could do so via Skype for Business. If you have any specific questions that you want to ask. Again, really want to thank you all for your patience. You've done very well overall this trimester. The results for your assignment will be out shortly. I've been really pleasantly surprised by, I'm going to say, the majority of them. The majority of them have been very good. Those of you that receive substantial feedback, the goal of that is to really improve the quality of your writing. And I would encourage you guys to take that on board and try to do something compelling with it. And what I've mentioned is that we have a graduate studies journal. Those of you that have gotten a good grade outcome on something that is topical, where it has been suggested that there is some scope for improvement, I'd encourage you to do that and maybe look at publishing it in that graduate studies journal. I just think it's something worthwhile to do. And putting your name to something, getting your name out there is always compelling. Having the material read by your alum through our alumni publications and graduate publications, I think is worthwhile. All right, so I'd encourage you to do that. Your results should be released, as I said, Friday or Saturday, depending on when you submit it to me. Again, this is a democracy and a meritocracy. If you're upset by anything in that grade outcome, if you feel like you've been harshly dealt with, you can certainly email me. I was the one that marked them, so I'll take it on board, more than happy to have a look. With that said, I think I'm pretty fair, and I do get a second marker to look at them. All right, so we try to do that, particularly with those papers that are at either extreme. The overall results, I think, are skewed very favourably. I think that the overall average mark is actually quite high relative to previous years. I'd say it's at least 1.5% higher in the preceding 2 intakes, which is really good overall. Okay? So, with that said, these next couple of weeks are the most important weeks. Or particularly those of you that have not done any graduate study before, or those of you perhaps that come from models of education that are a little bit different around testing and examination. All right? So I really encourage you guys that do have issues, as I said, call, my number is there, email, make sure you reach out now. I know I've said it a few times, but there is very little that can be done in the last few days. Okay? So I do historically get a lot of students coming in to see me on the day of the exam. And there's very little that we can achieve on the day of the exam. I'll certainly see you, more than happy to. But just being honest with you about the timeline. Okay? So, and thank you all for all your patience, all your discussion, and I dare say, on occasion, your candor. If you do want to discuss anything careers related, if you require any support around placements and so forth, again, do feel free to reach out after the exam. More than happy to assist you with placements with any of the firms that I've been involved with, or the firms that I'm currently working with to require interns. It's really important that you start thinking about the trajectory outside of this
course. All right, well, I'm going to stick around for another 20 or so minutes here to have a chat to anyone who would like to have a chat. Shortly thereafter, I'll be at the corporate centre for about an hour and a half. Okay, but I won't be available beyond that because unfortunately this evening we have a substantial number of foreign groups coming through for conference sessions and executive education sessions which start this week. All right, so I will not be available for the rest of this week, but I will be available again next week on, okay, between 9 and 7:30 every day to take a call. Or if you'd like to meet me, please arrange a meeting via email. All right. All the very best with your exam. I'm sure you're going to do us all proud. Sorry, Sahil, wait, did you contact Justin? Did you contact Justin?
Mail him.
Oh, you haven't mailed him yet? Oh, okay, no, just checking. Sure. If you need to take a sit us up, it's no big deal. I'll give you a hand when it comes up. Yeah? Just print out these questions, print out the revision decks, review them really well, you'll be fine. You'll be fine. All the happy to pass on to people that are chat. Lose a lot of money. It's very volatile at the moment. You can't speak in such and it's probably not appropriate for me to do it. So I can certainly put you on with yourself in the comments. It's hard to do, say you hear something like that, know a lot about the process and where there are lots of things to university. Other than that, when you're ready, drop me an email with your CV and I'll pass it on. No, maybe it was cool. What did you no, look, it may well have come through. Maybe it was all good. All good.
就说它的 maximum 笔记本一写出来就很下去。
Yeah, so it's come together very well. Most certainly, yeah. Wonderful. Look, I can see it's good.
yeah, I'm hoping that we get at least 20 for each session, and that means that we can run a whole heap of different presentations. And it gives people a bit of insight into sort of professional practice as well. And the plenary session coordinators are all from opposite consultancies. It's a way to network as well. So historically, not everyone has sort of seen the benefit of what they've actually done. All the students that I placed, not a huge number last year, maybe about 7 or 8 high school students, they all did that little bit extra. It counts. So if you're pretty frequently doing some iteration of probably something and more likely than not, probably something offered by one of the accounting bodies. So something, yeah. So I think certainly that one possibly. Yeah. Cool. All right. No problem. Okay. Yeah, there are some. I've given you 2. I'm going to give you 1 more. Have you seen the 2? Yeah, cool. So it'll be similar. Every semester will be dramatically different. There'll be probably about 30% variation. So every year it changes about 30%. So in the last version we did a lot of bachelor core, but we didn't do as much implicit rate calculations. In this version we're doing a lot more implicit rate calculations, but I've actually told you guys. Oh yes. Every semester, 30% variation. If you can do those 2 papers well, you should be feeling pretty good. Yeah? Are you feeling good about it? Good, good. You've got to be confident about these things. All right? You can certainly email or call if you need any more help, okay? No problem. Best of luck. See you guys. All good. The bachelor chord is outside of the scope of this version of the paper. Okay? All the best.
See you next time.
I know you're going to do well. All right? Cheers.
Cheers.
How you going? No problem.
The simulation. Could it pass or just one?
Okay, so the way that it works is I don't block people from doing it again. Okay? But I just know which one they did first.
But how you mark? Like
Do you
which
want-
one you?
I look at the first mark.
Okay.
Yeah.
First mark.
Yes. Well, you can retake it as much as you want for learning, and so I haven't blocked that. But as a matter of fairness, you know, I have to. If you had a technical reason why you'd like to take it again, then that's fine. You can. What do you want to take it again? Did something happen? Yeah, I know. It's good. They learn a lot, but then it changes the questions, but they don't get any high score. I'm sorry. Yeah.
It adds to them.
Well, no.
It's not the same question the second time around.
Well, it can be, but if you get the same question the second time around, for the first few iterations it will be, and then it can change to an alternative version of the e-learning. But if you take it again, it just says, hey, well done, you've taken another attempt, and it just shows me all the attempts that you've done and when you've done them. So I only take your first attempt, sorry. Because we have to be fair to everybody. Yeah.
And you can just keep going until you get 100%. But even if you haven't done the reading, you just look at the sort of like the
That's the problem with that model, though. I mean, it helps because people love the people that offer things like that, but it really lacks rigor if you look at their 10th score. You know, I can, through randomization, you know, achieve it. I mean, they shouldn't be doing that. It's so frustrating because then we all revert to that, and then it ends up with there being no rigor in things.
like 2 weeks ago when I was reading on there, I just went through the first one, just had a look at the correlation between sort of the true and false and where that number spits out, so it's got to be this one.
Oh my gosh! See, but you're using a data science method, Bayesian approach. Very good. Look, it's all good. Look, I used to sort of chair that one. I've chaired that one in the past as well, and it used to be assessed differently because it was a part of a different program. So it used to be a little bit different when it was part of an MPA. But it should not be that way anymore. There's a new standard, and it hasn't been for a number of years, so I don't know why it's changed again.
Like it does randomly generate numbers, but you just get the sort of
The trajectory.
Thanks, Michael.
All the very best.
Yeah,
Well, I was going to say, as an aside, if you are keen on the AI stuff, very, very keen to kind of bring everyone together that's interested in this. I know that you have an interest as well, so would love to avail you guys to what's happening. And it may well be that we have a speakers bureau and people that can come out and do sessions if you're ever interested. I'm sure that the university would be keen to have that level of engagement with industry groups and organisations.
I
So.
sent an email to the dean saying, well, how do we now, I'm about to finish my MBA, but then how do we renew that? I mean, and it may not be the little master classes, but it may be a day's seminar on topical issues, for professionals. So
Well, the executive education model, for whatever reason, at Deakin, because we have Deakin Prime, we've never pushed it within the business school, and Deakin Prime has technically dominated the Australian market around executive education, but it's been very embedded, and the problem with the model is that it's really geared towards very big organisations. So we run all of the training and educational programs for Lend-Lease, for ANZ, NAB. We're taking on Westpac as of this year as well, which is great for us. And a lot of us are involved through Deakin Prime, but that's technically completely separate to the university, and it's not available to everyone. So the problem with that is that you technically have to be with one of those organisations to benefit from that. And so we've only just started running executive education again in the last 2 years through the actual departments, because our professional services recruits people from all over the country and around the globe to run those programs, and only a handful of us have ever worked with them. And I've worked with them and I've seen how beneficial the programs can be, but we're not allowed to run any of those programs for anyone within cohort, but we now have the executive education division, which technically can now draw from that same pool. So technically the executive education pool is for high-level executive training in small groups, and now Deakin Prime is for major partnerships. And so Deakin Prime is still going to carry, for example, the Just Group partnership and all of those sorts of partnerships, but we'll carry all of the executive level and small group training through a direct relationship with industry groups. It is going to take some time to get going again, because we actually consolidated all of that in Deakin Prime. It's kind of similar to Melbourne Private, if you're familiar with Melbourne Private. It works well, but it can kind of go the Melbourne Private way if you go too far the academic way. So Melbourne Private was very, very similar, but it had a very strong academic model as opposed to an applied sort of practitioner model. And they did exceptionally well for a couple of years, were very, very well funded, but then they folded. I think that the reason that Deakin has done so well commercially has been because they've taken a more professional services approach to it. But the challenge with that is that you always go for scale, and you don't really pursue the relationships that you should. And it sounds disingenuous, this isn't being recorded, but if you do that, you end up only servicing the top end of town at the expense of kind of everybody else. So I'm sure that there would be a keenness to sort of to do some things. Yeah.
no worries.
Cheers. I'll shut down and we'll at the same time. Cool. I'll just do that. No, all good. I've enjoyed the time with you guys. Cool. Where's Chewy? Is Chewy?
I'm just guest lecturing.
Ah, okay. He's doing the last one? All right.
I'm Lincoln.
Michael, nice to meet you, Lincoln.
I'm from Beacon.
Oh, very, very good. So you're doing some employability stuff?
Yes. So in the capstone, the third assessment is
Oh, nice. Very cool. One of the other graduate units in financial markets.
Okay, cool.
But it's funny that you should mention this, because I've been talking to them about credentialing and employability the last 2 weeks.
Okay.
So I perhaps should be talking
Yeah. Is this for the BCom or?
for the MIF and MBA.
Okay.
Yeah.
Well, I know that one of my colleagues is working with the MBA
Okay.
and then for the MBA, it's Nicola Corner.
Okay.
In the MBA, we don't do
curriculum stuff as much as Nicola supports.
It would be beneficial. I dare say that some of the cohort in the MBAI in particular is quite similar to an undergraduate cohort in terms of commercial experience.
Yeah.
So they would really benefit from it.
Yeah, and also as international students,